Welcome to week 9, and this week we're going to be concentrating on the Elliott wave, how to count the Elliott wave, how to understand what the market's telling us, how to use the 534 oscillator, and also we're going to practice counting how to determine the end of a trend, and we'll go all the way up to big 5 waves in the Elliott wave, all the way down to a single bar analysis. So let's get on with it. Day 1, week 9, the Profittunity tools. Our goal this week is to define and understand the 5 magic bullets in the Elliott wave. The 5 magic bullets will basically kill any trend, and the most important information you could possibly have to trade is where is the end of a trend. So let's break that down now, and let's go to our job for today. Our goal today is to understand how and why the 5 magic bullets in the Elliott wave are used in the overall technique. We want to look at single bar analysis, and by the end of the day we want to understand and we want to define exactly what we mean by divergence. The 5 magic bullets are these, and these will kill most any trend. The first magic bullet, and there's no particular order, they all have to be there, is price in the target zone. The second one is a divergence between the price and the oscillator. The third is a fractal. All trends will end in a fractal, and all fractals will have a squat in one of the top or bottom 3 bars. And then we want to change in momentum. Let's break that down, and let's first of all look at divergence. Here we have a chart where the price is going up, and then it comes back and goes up, comes back and goes up again. This is the price chart. We look at the divergence between the momentum and the price, and here is the 534 oscillator. We call it the AO, and AO, as you know, stands for the awesome oscillator. And we really believe that we count the Elliott wave as good, if not better, than anybody in the world. Now that may seem immodest, but we have a secret. And that secret is we count the Elliott wave on the momentum chart rather than the price chart. What divergence is when the price goes higher. For example, in this particular chart, the price starts, it comes up here, it comes back, and then it goes up higher, but the momentum does not go up higher. So at this point, we have a high price at that particular instance in time, and we have a high momentum. Over here on the right, we have an even higher price, but notice that the momentum is not as high as it was there. And that's the definition of divergence. The price is going up, but the momentum is not going up. So here is the divergence between those 2 angles. Let's take another look. Let's take a look at double divergence. We have a price chart here that's going up and down and up and down, and then we have the oscillator, the 534 awesome oscillator. We have a price at this point, and then we have a higher price. We have momentum at a high at this point, and at the second point it's less high. That's a divergence. Now if the price continues on up in this region higher and the divergence still comes down, which means that the momentum at this point is less than it was at the middle point and less than it was at the beginning point, that we call a double divergent. Now it takes a price, a higher price, and a second higher price with a high momentum, a lower momentum, and a second lower momentum to create a double divergence. Let's look at that in the market. And by the way, almost all trends will end in a double divergence. Every now and then you'll see a triple divergence, and very rarely will you see a quadruple divergence. So let's look at an actual price chart here. This is the movement, the direction of the movement of the highs. We have a point 1 here, which is a high, and at point 2 we have a higher high. And now let's look down at the 534 awesome oscillator. At point 1 we have a high, but at point 2 we have a lower high, and that's what we refer to as divergence. So the difference between those 2 angles is divergence. Now let's break this down very, very small, and let's look at 1 bar. So if we have divergence in the market, and then we have what we call a divergent bar, this is only 1 bar. A bearish divergent bar would have a higher high and a higher low than the previous bar, but it closes in the lower half. Let's take a look at that. Here you can see on these green bars, we're in the green zone, we have a bar, we have a higher high on this middle bar here, but it does not close in the lower half, and here we have a higher low, we also have a higher high, and it closes in the bottom half. Now, what that signifies in market behavior is that the beginning of this period, no matter what time frame it is, whether it's 1 minute or 1 hour or 1 month, the buyers were in control, and they were able to take the price up to here. But we know that at the end of this bar, again, no matter what time period we're talking about, that the sellers were in control. Now, if you really want to get aggressive in trading, what you might do is sell this, even though it might be outside the alligator's mouth. Now, what we've been talking about for 8 weeks now is using the alligator as our odds maker and as our decision maker. If the price goes away from the alligator quite far, the alligator will act like a rubber band. It will try to pull it back. So the first job we have is to learn exactly what the rules are, and then as we gain experience and develop the art of trading, we know something even more important, and that is we know when to break the rules. Let's look at this on a bar chart. Here we have a bar chart, and the market is coming up. The new information pushes it away from the alligator. It comes back toward the alligator, then some more new information comes up, and look what we have here. We have a bearish divergent bar. Not only is it a bearish divergent bar, it's also a squat bar, as signified by the blue color, and it's a 3-3 extreme. Remember from the novice level and from our first book, Trading Chaos, this is an important squat. So if you were very, very aggressive in this area, you might choose to sell the bottom of this, even though you're going back in and you might normally be feeding the alligator. There are a couple of advantages to doing this. If you do this, you have the world's best trade location. You also have a very short loss potential, because if you went short here on the red bar, your stop would be just above the blue bar. So you would have a minimum risk here. Reviewing, a bearish divergent bar has a higher high and a higher low, but closes in the lower half. This is an example, and this is a perfect example here. That's a bearish divergent bar. Let's look at a bullish divergent bar, which is basically the same thing, only on the other side of the chart. It's on the bottom of the chart. A bullish divergent bar has a lower low, and it also has a lower high than the immediate previous bar, but it closes in the upper half. Here we're in the red zone again, and we have a red bar, a 1-3 bar, followed by a 1-3 bar, and then this bar has a lower high, the third bar, and it also has a lower low, but it closes in the top half, and that creates a bullish divergent bar. Let's look at that on the chart itself. And on the chart itself, we have here the market is coming down, and notice that this is not a bullish divergent bar. That's not. That has a lower high and a lower low, but it closes in the lower half, so that doesn't count. This one doesn't count because it doesn't close in the upper half. But look at this one. It started here. The sellers brought the price down to here. The buyers brought it back up to here. It has a lower high. It also has a lower low. So therefore, it is a bullish divergent bar. Now, let's practice this a little bit, reviewing just for a moment. A bullish divergent bar makes a lower low, lower high, closes in the upper half. A bearish divergent bar makes a higher high and a higher low, but closes in the lower half. Let's look at this on a chart. Let's see if we can find some divergent bars in this particular chart. Here's a couple of hints. There are 4 divergent bars on this chart. If you're having a hard time seeing these, all 4 are on the left side of the chart. 3 of them are blue bars, and 1 is a red bar. So let's start over here and see if we can find any. Here's a lower high and a lower low on this bar, but it doesn't close in the top half. That's followed by another bar with a lower high and a lower low, and it closes in the top half. Not only does it do that, it's also a squat bar. So this would be a bullish divergent bar. Here are all 4 of them. If we come over here to the middle part, none of these, this is not a bearish divergent bar because it doesn't close in the bottom half. This is not because this is a bullish divergent bar here. This also is a bullish divergent bar here. It opens down here and it closes in the top. So we have 2 bullish divergent bars side by side, and then the market takes off. Then it comes back and we have another bullish divergent bar, lower high, lower low, close in the top half. And then we come up and we have a bearish divergent bar, and it is a squat bar. So that's pretty important, and you can see what the market has done after that. So what we're doing now is we've looked at the bullish and bearish divergent bar, and let's take a little bit more practice. Let's see if we can find some more. Now there are a number of them on this chart, and let's start over here at the end, and we'll go down this direction and see. We'll mark them each one. What we want to do is mark the bearish and bullish divergent bar. Here's our first one. It's also a squat bar, notice, and notice the bar just to the right of that. That's also a bullish divergent bar. Now we're coming up and we keep going. Here is another bearish divergent bar moving on up. We have a bearish divergent bar here, and if you were really trading this, you would have a stop at the bottom of that bar, but that was never hit. And we come on up here to nothing in this area, nothing in this area, and we have to come all the way over here to find a bullish divergent bar. Now, had you taken the top of this and bought it, you would have been filled over here. You would have never gotten out because your stop would have been down there. Let's see if we can find any more bullish or bearish divergent bars. As we're moving over here, this is not one. What about this squat right here? That's one. That is a bullish divergent bar. As we're coming up on these greens in this area, is there anything here? It looks like that might be a bearish divergent bar, doesn't it? So if you had your stop in at this point, your stop would have been at the bottom to sell at the bottom of this. It would have never been hit. Then look at this bar at the top. That is a bearish divergent squat. And anytime we get a bearish divergent squat that's away from the alligator, remember this is going to act sort of like a rubber band, that might be one to take for the very aggressive traders. If you're not a very aggressive or experienced trader, we suggest you don't do this. But again, this is breaking the rules, and the key is knowing exactly when to break the rules. Now we want to show you something else. We want to show you how the alligator and the Elliott wave work together. And you don't really have to know exactly how to count the Elliott wave precisely, although we're going to spend this week doing that. The alligator will take care of you. Anytime the price is outside the alligator's mouth, you're in an impulsive wave. Anytime the alligator's inside the mouth, then you're in a reactive wave of the Elliott wave. And we look at the market as if it's a racetrack. And in the racetrack, you have straightaways here, and you have curves going around. And the cars go around these at different speeds. For example, we'll divide the straightaways from the roundabouts, or the curved end of the racetrack, and we have a car here. And this car is a racing car, and the object is to get there before anybody else does. Now let's assume that on this racetrack you can go an average of 200 miles an hour on the straightaway. But if you go 200 miles an hour on the curve, then you're going to have an accident. You can only go about 140 miles there. So if you're going to be a conservative trader and say, I'm only going to trade at 140 miles, everybody else is going to leave you behind there. If you're going to be an aggressive trader and say, I'm going to trade at 200 miles an hour, then you're going to reach havoc. You're going to have a wreck here. The way to look at this is anytime the gator is open, we're in a straightaway. Anytime we're in an impulsive wave, we want to trade the market and take profit from it. So in the top straightaway and the bottom straightaway, we have both an open gator, and it's also, from an Elliott standpoint, an impulse wave. On the ends of the racetrack, we have the closed gator, where the price bars are intertwining with the alligator's mouth on both sides. And again, if you trade at 200 miles an hour, here's what's going to happen to you. You're going to have a crash here. If you trade at 140 miles an hour on the straightaway, you're going to be left behind. So think about that illustration. We think it's a good one, and we think about it all the time. Where are you on the racetrack of the market? If you're in an impulse wave, if the gator's mouth is open, you want to be there and be there aggressively. If you're in a correction wave, you either want to just stay out, keep your powder dry, or trade on a much smaller time frame. and because on a much smaller time frame, you do have some impulsive waves in there. So that's about enough for right now for today. Reviewing what we've done today is we've looked at divergences, we've looked at double divergences, we've listed the 5 magic bullets, we've taken it all the way down to 1 bar so we know what a bullish and bearish divergent bar is, and we've used this illustration of the racetrack to impress you, we hope, that you trade differently in different time frames, you trade differently in different Elliott waves, and you trade differently depending on whether you're inside or outside the gator's mouth. So have a good evening, have a good date with yourself this week, do the morning pages, and the AT will be back with you tomorrow.